Welcome to Trading Nation. I am Brian Sullivan. Today we're joined by Jim Keenan. He is co-head and CIO of credit at BlackRock. Jim, welcome. Thank you very much for joining us.
Thanks for having me, Brian.
I want to I guess we're going to go back in time about 2 years because we were all over the oil's relationship with the high yield bond market story. Oil's decline causing a lot of concern in the high yield bond market. Well, oil's been weak again. Do you think we need to worry about high yield again?
No, I mean, yes, as obviously we should worry about high yield with regards to oil, but I think the magnitude and the difference between 2 years ago and today is significant, right? When you talked about the move 2 years ago, we were at a steady state that was oil between 80 and 100 that collapsed, and no high yield credit was really set up for that. Since that downfall, a significant amount has happened, right? They've equitized a lot of their debt, they've issued equity, they've hedged out production, they've increased their efficiencies, and they've obviously reduced some of the servicing costs. So even though oil has been a bit weaker from the credit story, they're actually in much better shape today, and you can see that reflected in prices.
Yeah, the high yield market, at least, as somebody that's not in it every day, I'm just an observer, seems to have, I don't want to say come back to life, but done okay recently. How would you categorize it?
Yeah, I would say, I mean, if you think about a low growth environment, and obviously post the commodity cycle, we had some pretty big cyclical tailwinds since, I would say, mid last year that escalated post the election. But that's obviously driven equity prices. It's driven credit spreads back to where they are today at the tights. But from a credit perspective, a low growth environment is pretty good, right? I mean, you don't necessarily need to see excessive earnings growth. You just need to see some stable earnings growth. And that's where we're in right now. And that's a good credit story, and which is why we're back at the tights.
Yeah, if we look at the HYG ETF, I know you're not an ETF guy. I'm not going to ask you specifically about it, but it was at 95 and it went down to 75 during the sort of the oil crisis. We're back to 88. Do you see the high yield market as a whole regaining what it was maybe 5 years ago?
Yeah, I mean, the biggest question with regards to the pullback 2 years ago was the commodity, energy, and metals and mining ultimately going to roll into a global recessionary environment, right? And so by the time you got into Q1 of 2016, recession risk had skyrocketed, and that started to get into pricing all assets. Today, obviously, that's rallied back up, and high yield is 400, 450 over, so it's not cheap. But the underlying foundation of the economy, and certainly the U.S. economy, is pretty strong right now. And so I would say that we look at the high yield market as a stable carry trade, and you have to watch the same risk factors that are going to affect the equity market right now.
How's the Fed in relation to the high yield market? I mean, what would you like to see them do?
I think the Fed, the best case scenario for the credit markets is ultimately going to be a Fed that is going to gradually increase rates as the economy improves and inflationary pressures start to come up. If the Fed starts to increase at a fast pace, I think that will start to put volatility back into credit spreads and the equity market. So I think that risk was somewhat pulled off the table earlier this year as the Fed started to show its hand that it was still going to move at a gradual pace.
Finally, what is the biggest risk to the high yield market? Maybe to the bond market in general right now, Jim?
Well, I think you hit it on the last question. I mean, I think the pace at which I would say global monetary policy shifts and changes is going to be probably the biggest impact. I would say from the second order would probably be whether or not we see fiscal follow through, right? Obviously, optimism has grown dramatically on the promise of fiscal stimulus. And if we don't see that follow through into the back half of this year and early next year, I just think some of the growth optimism will come off the markets.
Jim Keenan of BlackRock. Jim, it was a pleasure to get you on Trading Nation. Thanks very much for joining us, and we hope to see you again, okay?
Thanks, Brian.
Thank you. Folks, thank you for tuning in. Catch the live version on CNBC's Power Lunch. I'll see you there as well. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.